All right, good morning, everybody. So we're back at it, new week. Still got a lot of bricks in the wall of worry, although one shoe has finally dropped. Conflict in the Middle East will mess with energy costs. Energy costs will mess with everything else. So at this point, the question is, how long will the conflict last? The projections so far seem to say short duration seems to be the higher end at the moment. Stocks are already trying to bounce a little bit off lows. Energy pulled back. When it comes to energy, the Strait of Hormuz will be the biggest outlier. So as long as it doesn't get jammed up, if it's only closed in isolated sections but still remains passable, then crude shouldn't get above 100. If the strait gets closed, then 150 easy. Wouldn't even be much of a question. Everything's connected, so of course, red around the world. We've got some manufacturing data this morning, 9:45 and 10 o'clock. That's a little different than what we're used to, right? Some of the bigger economic data comes in at 8:30, so it's usually before market opens. This will mess with the open range traders that play, the 30-minute open range or 1 hour open range. It's another argument for doing short side 0 days in the afternoon. Just miss all of this in the morning. The numbers projected aren't way out of line. So as long as we get results that are also close to this, then we shouldn't see too much drama. We got some auctions today, but they're way up on the front end of the curve, and they are not the 1 p.m. auctions. Now, don't take that out of context. Whenever there are auctions, you want to pay particular attention to them. There's three groups, some that come in at 11, some that come in at 11:30, and then some that come in at 1 o'clock. It's nearly always the 1 o'clock auctions that cause drama, if there's going to be any drama. But just because we have auctions at 1 doesn't mean we will get drama. And today we don't have that 1 p.m. auction. So these others could certainly ripple the markets. It's always possible, not likely. So just be aware, watch the clock, anticipate that we could get some reverberation, some flows when those auctions come in. The call wall rolled up. It hasn't. They haven't had time yet to show us where the new call wall is going to be. So you already know where it's at. Watch those strikes to see it get unwound, and then try to spot where the new wall is getting developed. Either way, we'll see it tomorrow, right? Or if you've got spot gamma, you probably see it through the day as the new level gets built out. But the snapshot from spot gamma is from how things were Friday at the close, right? It's not picking up how everything is at the moment. White House risks are light or moderate. This goes from 0 to 100, 100 being, oh, damn, extreme. So if we're sitting at 25, it's like a little speed bump. Still, there's always the possibility that it could, increase through the day, but that's where we're sitting at right now. It's just moderate level. It's really low. If you look at what's going on here in the sentiment index, a lot of it is, of course, the Iran conflict escalation and defensive sector rotation. Right now, interest rates and job numbers and the Fed are below all of that, right? The market has completely turned its back on that situation for the moment. We'll get back to it later, right? That's one thing about the market. It's not going anywhere. So you can certainly keep your eye on the Fed watch. I would never, recommend ignoring data, but I don't think you're going to see much change in the curve at this point, right? I think this is kind of going to take a back seat to everything else. Precious metals and crude are, of course, moving with the war vibes. There's a historic precedent to that, by the way. At some point, they're going to diverge with um, energy prices fading back down and the precious metals continuing to stay elevated. That's the historic precedent if this all resolves relatively quickly, right? All right, so you can see the put wall, zero gamma volatility trigger, and the call wall back up at that 7111 cog line. It's way out there. We did leave a gap between Friday and Sunday. That needs to be resolved. To get there, we've got to get through the threes. That's the 3-day and the 3-week. And then we've got to get through the tens, the 10-day and the 10-week. We can get the gap closed and then get into the tens. Then we'll challenge the RTH of Friday. So if you're not used to that phrase RTH, it's the regular trading hours. We got just this zone here with the RTH, and then we've got all of Friday that we can measure, right? And the difference would be quite a bit if you're using the quad lines or the quadrants. So if you want to just keep it simple, just measure the entire thing. You want to focus on Friday's low, Friday's mid, and Friday's high. Of course, all of that is dependent on us going back up and getting through 0 gamma. So we're in negative gamma right now, and we're deep enough into it that we could see the behavior that we expect to see, which would be if we start to fall, dealers are going to want to remain delta neutral. They will sell into that selling. And if we start to rise, then they will buy into that buying. It's why when we're in a bear market or we're in negative environments, we get these really big bars. Rather than in good, clean, bullish markets, we tend to get more smaller, uniform-sized bars. And that's because in a general market, in a typical market, if we started to sell off, they would buy it to get delta neutral. And if we started to break out and go higher, they would sell it to get back to delta neutral. So they're rolling with the move instead of against the move, and that can make the moves a lot bigger. This wedge I had showed last week, lipstick on a pig. We were looking for that breakdown. We've got it. The concern now is that on a move to the upside, we could Busby off the bottom of it. Busby's an odd term. The idea being it's an old technical analysis idea that when you have a market in a range, sooner or later it's going to break that range, right? So it tests, finally it breaks. Oftentimes a market will come down and check old resistance as a new support before continuing the breakout move, right? That is a Busby. So now it's the same thing the other way around. We have that wedge drawn. Price broke the wedge to the downside. We could, which was considered support, so we could come back up and check that before going lower. Which would imply that we get another run up into 68.50. That's basically our Globex high. Then reject and fade back down again. 67.50 is still the bottom of this structure. Now, just really generic technical analysis would suggest that you measure the widest part and that you overlay that at the breakout point, because that gives you your downside targets. Generally speaking, once you've done that, you want to aim for half and then aim for 100%. So you got 50% and then 100%. It doesn't owe us these because we still have to get outside the bottom of this leg here. So if 67.50 breaks, we're running to 6,700. Get below that, you got the 200 period daily moving average, which is basically 66.50. And then 65.50, because we've been running 50s, and I'll still argue that we're running 50s. So that would be the, oh damn, things are getting really bad scenario. But we're not there yet, and we don't have any reason to believe we're going there, right? Markets are mean reverting, or at least the indexes are. So, you know, whatever move we're going to get, it's very likely we will retrace at least some of it. And it's a good demonstration that we already had last night. We were down a lot more. We've already retraced some of it. Overnight participation, 206,000. We have a wee bit of participation, right? The average is around 52, 55, and we're running at 206. So they are not sitting out, that's for sure. They're in there swinging it with both fists. The reason that this is concerning is, and most newer traders really kind of overlook this, most of the trading that happens in the futures, or at least in, we'll just say it that way. Most of the trading that's happening in the index futures, the ES, the NASDAQ, is not done in speculation. That's what you do. It's what I do. It's what retail does, right? We buy it here expecting it's going to go up and we get out there, or we sell it here and we run it down and we get out. We think it's going to go somewhere and we want to make money on the move. That is speculating. It's what we do, right? It's no judgment. That's what pays the bills. But most of the trading that goes on in there isn't that. It's payroll, or it's hedging some other product, or you know what I mean? It isn't speculation. They have no vested interest in, quote, being right or getting in and catching a directional move from point A to point B. So this participation here isn't some, wave of speculation where everybody is running in here trying to buy the dip, or take it from point A to point B. So keep that in mind. We want to see what is lacking. If they're all piled in here, what isn't getting flow? Keep your eye on that put wall through the morning. See if we can target its new home. It's very likely we'll see that rolled at some point through the day today. They'll be exiting out of that area and targeting a new area, right? So the flow should stand out. It was interesting. I heard it on the radio. They were talking about how, oh, it was such a big drop, blah, blah, blah. Really? Such a big drop. It went right to the ADR. Come on, that's what it's supposed to do. We didn't move an outsized move. This is a normal move. We went as far as the market should have gone. Average daily range. This is the 21-day average, 102 points, and we went exactly that, right? So if you take that 102 points and you split it in half from where we opened, there's 51 points this way and 51 points that way, and in between those two lines is 102 points. We've already moved as much as we should move today. So if the market continues to behave normally and rationally, then we're done. Now, if we want to get bared up, we could move the entire 102 points in a single direction, and that would put us down here at this yellow line. Of course, there's a market phrase that I use a lot. If we get to one edge early enough in the day, we can go to the other edge by the end of the day. This isn't bullish, by the way, right? This is just the way markets move. It's just the wave, right? If we went down, then we got to come up. So that upside move, while it might seem bullish because, well, we're going up, there's no bias to it. It's just a part of the wave formation that price makes. So we want to focus on getting back up to that level, or any signal that says, hey, we're not going back to that level. This is our Globex range that we're dealing with. As long as we're holding above the midpoint of this, we can challenge the high. If we challenge the Globex high and we get through that, then we've got the ADR half on the upside. And that's really all that it owes us. It doesn't owe us, like 69.22 way up here. To even get there, we would have to break outside of Friday's high. And while technically that's possible, there's really no reason to think we're going to get so joyous today, right? What would be the bullish exuberance that could get us up there? And into escalations could do that, but I don't see that on the table today. Tinfoil hat, we've developed all these new war toys, and well, they want to test them out. So I don't see this conflict ending until everybody's had a chance to test their latest toys. I know it's a bit jaded, but and what can I say? That's where I'm at this morning. If we get back down through this midpoint, which is 68.11, then we'll focus on the ADR low again, break that low, and we target the full ADR. And along the way, of course, we've got the 111 and the 1236 for the breakout down here. We'll get the OCC, expand the drawings, and right, we'll run it as we go. Yeah, I mean, yes, the Fed could certainly become a part of the market's narrative again, but during the war vibes, the Fed kind of takes a backseat to market awareness, right? It's not to say they won't completely forget the Fed, but they're going to be more focused on this and less focused on the Fed and interest rates and job numbers. And yeah, they're the longer this lasts, the more we will focus back, right? The market will just shrug all this off eventually. But in the very short term, the market won't give two shakes. The weekly floor pivot went up just a little bit. This was last week's weekly floor pivot. This is this week's weekly floor pivot. The range of the pivot channel is narrower, not a lot narrower, but a little. It's about 50%. You know, it seems like we could take this red channel and we could fit it inside just one of the channel ranges, either the top side or the bottom side. So it shrunk up quite a bit, but it's not as narrow as it could be. So it's still wide enough. Wide channels imply that if we break out, it likely doesn't stick. But that's a weekly channel that we're talking about and a weekly range. So what we're talking about breaking out of and whether or not it's going to stick is a weekly candle. So this is last week's range. We are obviously outside of it. What we're talking about is the chance that we're going to come back inside that box. A wide channel implies that we will go back in the box, that we won't close outside of it. Just keep in mind that these channels, they don't make price do anything. So we have already broke out, and it's likely that we keep that breakout and that we don't go back inside the box. But either way, no matter what happens, the channel didn't make us do anything. Just gives us some insight on what we should anticipate or what we should expect. Today's floor pivot, lower than yesterday's, that's bearish. Price opened underneath it, that's also bearish. We have an MDP so far, but it won't count until tomorrow. We almost had one on Friday, but we did tag it just briefly, you know, but it counts, right? So that's not an MDP since we did hit it. So far today we have one. MDP is missed daily pivot. If we haven't hit it, then we missed it. But we can't count it until the end of the day when we look back and realize that we made it all day without hitting it. If we break up through our Globex mid, target the Globex high, and above that, target the floor pivot, level by level by level, right? Just like we always do. Destination trading 101. But we got to get there. It does look a little bit like left shoulder, head, possibly right shoulder, right? It does. It looks a little bit like that. And if we was to measure that and plot the neckline break, the destination would be up here into these pivot points. But I wouldn't get too hung up on the head and shoulders. Intraday head and shoulders is like the butt of all candle pattern jokes. Pretty much worthless. But it is nice to point it out and be able to say, hey, look, we got an inverse head and shoulders. Yeah, so what? Just focus on the levels. They'll get you where you need to be. All right, so we are back above S2. It's a good start to a recovery. If we break back down below S2, then we target Globex low, and below that we'll target S3. That'll of course get us below 6750, but it'll also be where we anticipate a bit of a digestion, get a slight pause possibly. If we do get moving back in the other direction, then Friday's high is close to R1. If we can get through R1, we've got S2 6950. Interesting how those levels just lay in all the right spots. That's the level that we've been interacting with. Came down here, didn't stop on a dime, but nobody was expecting that. We interact with that previous point of control. It's the same thing we did back here and back here. So I've pointed this level out before. That's why I knew where it was. We've been keeping our eye on that level 6780 area. There's not much left underneath that except the 50, right? So once we are back below 6780 firmly, then we want to focus on that 6750, 6700, and then 6650, level by level by level, right? For any discussion on the move back up, we don't have much this morning for our own week, which makes sense because this is the wrong time frame for that. But if we look at last week's range, the point of control for the week was around 6892 cog line. So we want to focus on basically 6900 for the upside move once we get past 6850. And we're at 6811 cog line, so we got plenty of room. But it's a big distribution zone, right? It's just big wad of chewed up bubble gum at this point. So that's a wide range of trash. Ten-day, 30-minute volume profile in TPO. There's not a lot here other than we can see that we're playing around in the shallow area, and that if we want to try to make a move to the upside, we got all of this trash overhead. But that's not new, right? So there's really not a lot here at this point. The chart at least is cleaned up quite a bit from the trash that we saw through January and February. So I guess it's getting some housekeeping done. We got a new VPOC from Friday. So now we got two levels overhead to focus on. Those are where the greatest amount of trading took place on that day, right? So we don't look at them as resistance in this case because they're over our head, just more of an area of interest and um, a possible high trade volume zone. If we get near it, it should show up on the queue, the active trader or whatever it is you're using, the dome. Should start to see more pulling and stacking and games being played around that level. And then, of course, once we get up into that zone, you should see it in the tape, the response, the pace of the tape, the size of the trades that are coming in. You should see their participation. We get through this lower one, then we focus on getting all the way through Friday's levels, and then we could focus on Thursdays. With Thursdays being just outside of Friday's high, not sure how much value we're going to get into it, but Friday's high all by itself is a pivot of concern, and then Thursday's level is just a few points away. looking at what's going on this morning, that's pretty ugly, all things considered. Not a lot of help at this point with what we've got going on in the profile. So it is just about the midpoint for most of that. Not a surprise. So you can see the point of control here and the midpoint here. We're just balancing everything at the moment. See if that breaks and we can shift the balance one direction or another. But for right now, that's all we've got. It thins out on either edge the way a distribution should. It's not quite a classic distribution, but work with what we've got. Now, on Friday, we examined this range that was developing. But on Friday, it was just a preview. It wasn't set in stone yet, and we didn't know how the week was going to end. So one thing I like to do on Monday is see what did we get. Compare this week's range to last week's range. We have the same amount of days. So the two components that make this range up is volatility and time. If last week was a 5-day week and this week is a 5-day week, then we have the same amount of time. The only other component would be the volatility. If we had less volatility last week than this week, then last week's range would be narrower. If we had less this week than last week, then this week's range would be narrower. And we can see that this week's range is just slightly bigger than last week's. But this range was built Friday before the close, so before the weekend drama, which means the market hasn't priced in this drama into this range. We could easily break this range and continue to expand because this range wasn't built with war drama. The reason that this candle is yellow is it's the first day in the new month. Just like this yellow one back here is the first day in the new month. There's a market strategy, day one open range, DOOR. It doesn't really work that well for the futures, but in equities, it's kind of interesting, really. It's been around for a long time. I didn't make it. You can probably check that out in a book. Just Google it. Day one open range. I had built this indicator expecting to test it on the futures, see if there was anything to it, but no. And I just left it in there because I wasn't going to undo it. It's connected to another indicator that marks economic calendar events, that sort of stuff. I wasn't going to undo it, so I just left it in there. But we are in the new month, so we've got that to be focused on as well, including triple witching coming up in 2 weeks, 3 weeks. It's always the third Friday of the month. OPEX, third Friday. So we'll be swapping out the futures contracts in 2 weeks. We won't wait until the contracts expire to swap them out. We'll do it the Friday before or the Monday of, depending on who's your broker. We are 1% below the 10-day. It's not extreme yet, but that is the average turnaround point. So going lower than that today does start to get us into a condition where we start asking, have we gone too far or not? You can see that we were deeper than where we are now, right? The S&P and the NASDAQ was off quite a bit more than they are. But they have risen up off the lows, so we're already starting to come back. Still at this point, 1% is the edge of normal, so we're not sitting in an unusual environment yet. Just keep your eye on the 10-day and how far away we get from it on the intraday today. We've already set a low, so we would need to go down, break that low, and begin expanding below that. and we are 1% below the 10-week. That is nothing. When we scroll out and look at what it could be, 1%, no, nothing there. So at this point, looking at the 10-week, we got no issues at all. Shouldn't have any issues unless we get below, say, 2.5 or 3% below the 10-week. Then we can revisit whether or not we're moving too far, too fast, and if we're going to get any sort of mean reversion. The expectation is that everything is red this morning. And yeah, for the most part, I mean, we got energy up, of course, but we don't want energy up because it affects everything and it's going to mess with inflation, cost, and everything, right? Nat gas or just generically XLE energy, gold and miners, silver. So that's up. Bitcoin, everything else is down to some degree. So if we get a turnaround, that'll be easy to spot. Won't miss that if every single thing out there is red, then it should be pretty easy to spot if we change that. So let's talk about how red it is. One of the good things about market breadth is you can quantify how heavy it is. I like to use the S&P 100 or the NASDAQ 100 or both. 100 makes it easy because whatever number you get, you can just convert that to a percent. 69 names in the S&P 100 are down at least 0.5%. We can convert that to a percentage, so we can just say 69% of the S&P 100 is down 0.5%. 69, we can just round that up and say 70. 70 out of 100, that's pretty bearish. It's not the most extreme we've ever seen, but it's pretty bearish. That's also representative of the broader market, right? 70% is a one standard deviation. So 70% of the marketplace is being affected by what's going on out there. And it's likely that the other 30 is either flat or slightly positive because it's actually making money on the drama, right? So you can just quantify that with how many are up at least 0.5%, 7. So there's your names that are making money on the war vibes. Mostly energy and Palantir. %62 of the NASDAQ is down at least 0.5%. So if we're going to see everything change, flip over and stop doing what it's doing first, and then perhaps go the other direction, you should see it collectively throughout the broader market. It would be a rising tide that lifts all boats. Because with everything this negative, the Mag 7 can't pull us out by itself. We would need multiple things, right? 0-day flows, dealer hedging dynamics, Mag 7, and even those combined likely wouldn't be enough. So with this negative of a broad market, we need a rising tide. We need to get breadth itself to participate if we're going to see some sort of upside breakout rally. That should be pretty easy to spot, all things considered. Keep your eye on the VIX. We got up to 25, but we're still holding above 2250. So sure, we're off of those highs, but we need to get below 19 and 1930, and we're a long ways from 1930, right? So we got to play it level by level. 50 cents and $1 is pretty easy to focus on. So 2350, 2300, 2250, 22, like that, right? 50-cent pieces. So we got the low. The concern is that we put in a base and we just build out a small range here and we get stuck in some kind of zone like that. If we get stuck in some zone like this, or even with it being a little bit more, if we just stop falling and begin basing and chopping, then the lack of losing volatility is going to keep the indexes stuck too, right? We need to lose this volatility. We got to get it unwound. So if it stops falling and it just starts chopping, even if it doesn't rise back up again, that chopping about, it's going to hold us back. So we need to see this volatility get unwound. And it's very likely that it doesn't happen today. It just depends on how fast we can get the market to digest all the data out there, which is why we want to keep track of the VIX. If some real guidance on what's happening comes out, then the VIX should get underneath 2250 and begin working its way back down into the 21 or $20 range. Back inside of Friday's range is what we want to focus on at the moment. Just getting into Friday's range is a good start. Simple enough, right? So we got our range, we got our levels. It doesn't really matter which direction the market goes today. It's a really good setup. All we got to do is start the move. So get out of the Globex and we can get this party started. Be careful, be safe, have a good day. I'll see y'all tomorrow.